And our next speaker is Tim Petry, Extension Livestock Specialist Economist out of the NDSU Ag Business and Applied Economics Department.
Well, good afternoon, everybody, or evening. And I'm really not going to have much different than John. We didn't get together and talk about these before, but what I have to say and my prices and so on really coincide quite closely with John. So I don't know if that was coincidence or what, but it came out. So move along here. Just a couple of housekeeping details before we go on. I do have this presentation on my website. You see my website there. This one I am not going to change, but I do have a cattle situation and outlook on my website. So most of the charts you see here tonight, if you go just to the cattle situation and outlook, you can find updates in upcoming weeks. But this particular one will not be changed. I did update a couple of slides. I'll try to remember when we get to them. I did update a couple just because of the down market today and so on. And like I said, I'll try that you might have in your handout if you made a copy, because I did update those. So again, John mentioned this, but all beef and cattle market classes have broken records for the last several years. So record high prices are not unusual. And in fact, last week we set all kinds of records. Both the live cattle and feeder cattle futures were record high last week on Wednesday. Now they did back off on Thursday and Friday, back up yesterday and down again today. So that's that volatility that John mentioned, and that is just going to be with us. But they were record high less than a week ago. All-time record high in life and contract high. The cash fed cattle market, I've got a chart to show you, was record high last week. And the feeder cattle, again, were record high last week. And unlike the futures that stumbled a little bit today at Oklahoma City, the cash market there today was up again on calves, and just some more on that in a little while too. So, down there at the bottom, what could derail prices? Well, from a fundamental supply and demand standpoint, we're in good shape, and into 2015 there, we could set a record again next year for sure. The first part of 2015, we're going to be above 2014 because we went up the entire year, but by the end of the year, next year, we expect prices to be similar to where they are now. There's a chance, and when you look at the fed cattle futures, that they could even be a little lower. But we could break an annual record. We will be higher in the first part of the year, and have to see what happens in the second part of the year with corn, and particularly for feeder cattle. So I like to show charts. I don't like to have word slides. But if I only had to show you one slide tonight, it would be this one, because it simply highlights the conditions and why we have record high prices and what's going on there. Only two things affect prices, and that's supply and demand. It's just that there are a lot of factors under demand and a lot of factors under supply. But what we have, of course, and you're all aware of this, is we have an extremely short supply of cattle. Demand is good. It's getting better, and probably next year will be better. But, on the supply side, our feeder cattle supply is very, very tight. I've got a chart to show you on that. Plus, we're keeping more heifers back, so the supplies available for feeding are a lot less. Our beef production is going to be down, has been down 6% so far this year, and is likely to be down 6% for the entire year. Steer slaughter down 3%, heifer slaughter down 9%, beef cow slaughter down 18%, dairy cow slaughter 10%. So, our slaughter is way down, and our birds have been liquidated. And when we're trying to rebuild, then we take our slaughter down. On the demand side, again, kind of surprising to a lot of people is how strong our exports have been. Our quantity so far, and we're about a month and a half to 2 months always behind on getting the final data. Even with record high prices and the dollar increasing quite substantially to many other currencies, we're actually still 1% higher on quantity. And of course, with the record high prices, our value of our exports are up 13%. Byproduct value, again, is due to the export market because we export a lot of our byproducts, including our hides and tongues, livers, everything else is record high. About right now, $16.50 per hundredweight on a live fed steer is due to the byproduct value alone. That's up a couple dollars from last year. On the domestic economy, our economy is improving slowly, and it's probably will keep improving slowly. North Dakota is the exception where we're booming, but the Detroits and LA's and New York City, more people are working, unemployment is falling slowly, so those are good signs for peddling meat, particularly at the high prices. And then, of course, another unexpected thing that happened this year on the demand side is we had lower pork and poultry production than we originally had thought. PED in hogs, and then some genetic problems in poultry. That will and is turning around for 2015, so that's kind of a concern for the second half of next year, in particular on fed cattle, is that we're going to have a lot more meat there. So with those words, then we'll just look at the charts. Again, John mentioned price volatility, and this slide I just kind of like to use because it shows over a longer time here during the ethanol era and so on how volatile prices have been. But the run-up in cattle, and this is just nearby corn and feeder cattle futures, has just been phenomenal. In 2010, feeder cattle futures were $90, and now they're $130, that blue line there. So, just in the last 4 years, just a phenomenal run-up. And, of course, corn has been all over the board. We've had $8 corn, and now today the nearby is $3.57, was up 11 cents to get it up to $3.57. So just a lot of volatility. There is a kind of an opposite relationship there that I'll show you next between corn and feeder cattle. So, we don't know what the corn crop is going to be next year. For sure we know we're going to have fewer acres of corn, but we don't know what weather is going to be. And the change in corn prices and the opposite change in feeder cattle can be quick, like it was back in 2012. When we had $164. The black line here is cattle. Just think of that we have a lot of black cattle, and the green line is corn. It's when it's growing, it's yellow now, and so that's the difference. But in 1 month we adjusted from 164 feeder cattle down to 140, and corn went from $5 up to way up to $8 in just a month there. So things can happen fast. That could happen next year. I'm not saying that it will happen, but it's a concern and something to be aware of. And this year then come down to a much more gradual change. We dropped corn that was up about $5 a bushel. Corn just went down from May all the way through now, and then on the other side, feeder cattle. As corn went down every day, feeder cattle went up every day. So we went from 180 up to 240, and now we've backed off to 230. But anyway, we have to keep corn in the back of our minds in moving into the next year's outlook that I'll give you in a minute. So again, a little bit on feeder cattle supplies. Of course, are lower than they have been for many, many years. I just go back to 1984 here. Last year is missing because just remember that we didn't do a July cattle inventory report last year because of budget concerns, and so, but it would have been kind of right in between here. Here's our feeder cattle supply outside of feedlots on July 1st, and that's the reason we have record high feeder cattle prices, is just because we have such a small supply of them. And on the replacement heifer side, this is actually January 1st, but we've been increasing replacement heifers. That takes calves out of the feedlot sector there, and coming up January 1st, that feeder cattle supply is probably even going to be lower because we had a lower calf crop this year, and this replacement heifer category is going to be higher. And so, again, on the feeder cattle side, available for feedlots, we're going to be very, very short there. I didn't bring the slide, but on North Dakota here on the replacements, we have quite an opposite situation. If I showed you the North Dakota slide, actually North Dakota replacements the last several years here have been the highest. In fact, 2013 was the third highest ever number of replacements we had all the way back to 1920. So be a much different slide here because we have been expanding in North Dakota. Go to these calf pricing again. John talked about that, but we just had a phenomenal run this year, as you're well aware of. Last year we were talking at this time about calf prices there in 2013 at about $1.74 or something now, or by the end of October approaching $1.80. Now they're $2.80, so we had $100 change in calf prices in a year. So yeah, John's right, they're expensive. Again, with this rapid run-up, everybody's asking how much further can they go, or are they going to go down? And the answer to how much further can they go is all based on corn. And so what we've been saying all along is, as long as corn keeps going down, feeder cattle are going to keep going up. But corn now has stabilized. In fact, corn prices are up 37 cents in October alone. They went down all the way through September. But in October here, just in the 2 weeks in October, they went up 37 cents. So corn is pretty well stabilized, probably not going to go any lower. And that means that that's going to put the lid on feeder cattle, but at record high levels. And again, volatility, maybe I'll talk about just a little bit more at the end. And we did see the $3 down on futures today. That was for a variety of reasons. One is corn went up 11 cents today. Fed cattle backed off some today, even though the cutout value was up today. Fed cattle were off some, and it's, we're ramping up pork and poultry production, and that's starting to show up. And so, at least from the futures market standpoint, that's a concern. The other thing is, if you watched throughout the day on the futures today, they were actually up a little bit there until 10 o'clock. Between 10 and 10:15, they fell $1, then they stabilized, and then about noon they fell the other $2 just in about 5 minutes. That is, the funds were bailing out of the market. The funds like bull markets, and so they have pulled out drastically out of the grain market because it went down, 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 and again, they're hedging against inflation, and so they like to go along, and so they have went to other things, although the last remaining place for the ones that do like to have some commodities has been the hog market earlier that then changed, and now the cattle market, and it's just today, they watch charts very closely and some reversal on the charts, and so it was the funds bailing out, but now, on the futures market side, actually the cash market, the nearby cash market, the CME cash settlement and cash prices are just for the nearby October feeder cattle futures the cash market is several dollars above the futures. And again, the October closes here the last Thursday of the month, only a couple weeks away, and so they have to be the same on that date. So that's going to put somewhat a floor on. We're not going to see futures just down $3 down the limit, or continuing down at a drastic pace. But anyway, in the longer term outlook out here in these calf prices, we've stabilized them here at these levels. There is winter wheat is really the best winter wheat we've had in the South for quite a number of years. I just talked to my counterparts in Oklahoma and Texas, Colorado today. We had a conference call, and there's a really good demand for winter wheat calves because the cheap gain is gonna dry up anyway, and so that's helping to spark these lightweight calves down in that country that we haven't seen too. But again, stabilizing here, maybe could even back off when the heavy runs start here, a few dollars by the end. And next year again, then we'll be above at, up in that 260 plus area for the next year. And again, depends on whether it rains and then how many corn acres does it look we're going to get and so on. But by the end of the year, where we are next year, likely to be, in this similar category. We aren't going to see another $100 increase in prices if that's what you're hoping for, but, still at good levels here. Switch to the heavier weight cattle, and again, about $80 above where they were last year. We've got the futures on there. We're right around 240 now, and these futures are a couple days old, but again, the nearby October futures now today are 239, and going to the November futures, the next one there at 237, and back them off a little bit more than that into the January, and today's at 231, and the March at 229. So anyway, that then. The futures kind of says the same thing I said on calves, is that the market is kind of leveled off. We'll be above next year. We'll be above where we were this year at the beginning of the year, but closer to where we are now at the end of the year. And we don't, it's not impossible, but further large increases are just not expected there. John kind of mentioned some prices here, and this is last week's weekly summary. I just want you to kind of concentrate on this. Like he said, AMS is usually reporting 4 markets in North Dakota, and now they're only in the last few weeks only reporting 1 or 2 because the calves aren't coming to market yet, because still harvest going on. It's wet out there. There's grass, but on these 550 to 6-weight calves at the 2 markets, there were only 100 of them. But look at the range in price there. The range in price there is from 265 to 290, an average of 281. So there's a wide range in calf prices. That range, when the heavy run hits, is probably even going to be wider than that because of all the different factors that affect calves. But when we get to a budget that I'm going to show you again, 265 works better than 290, and so that's all part of the equation if you're buying calves and pricing your own calves there. And here's the heifers. John mentioned heifers that are being discounted. So you go to those 550 to 6-weight heifers. Again, they're lower than steers, but these replacement quality heifers, if you go, there's some 552s at over $3 or more than steers. And so we're going to see more and more of that. The closer we get to spring, the more in demand replacement heifers are going to be. So we're going to see heifers selling at or above steer prices for the very good replacements. But right now, some of these market heifers are cheaper, and I agree with John. Will be a good opportunity. A little bit on slaughter steers, because that does affect feeder cattle prices. Again, this past week, we were record high, all-time record high prices. The previous record high this year was the end of July, which usually is a seasonal low, but that was had a lot of factors going on. Very short of slaughter steers, and retailers short bought and bought them back up. But now, last week, we're record high on slaughter steers, and again, the futures are at least still indicating, this is the top futures are for this year, indicating even some more improvement is possible a little bit by the end of the year, and next year be above what they were at the beginning. But again, by next year, could be a little bit lower on the futures, especially if, depending on how we ramp up pork production. So move along here then, as John mentioned, calves are very, very expensive. Should we sell them, or should we do some backgrounding? And yeah, if you sell them, like he showed, you're going to get $1,500 for some of those steers. I have a budget here in my website. Just Google livestock economics. It's not much different than John's. These are 550 in and 750 out, going 2 3/4 pounds a day. You know, he showed you about a $50 on them, and I'm showing you about a $50. What I just wanted to show you is, you know, we've brought calf prices up from 174 was the budget that I think I showed you last year. We had 174 calves in. We were projecting 155 out. We had $4 corn, and we were projecting a $50 profit. This year, 280 in, 230 out, 260 corn, and it's still $50. So every year at this time, the market says that people need $50 to background steers, and so that's what it offered. Last year we turned out a lot better because prices kept going up. Instead of 155, we sold them for 170 or more, and so instead of making 50, we made 150. We don't expect that to happen. Carl's laughing there. But we don't expect that run up in prices, and the futures don't indicate it. Is it possible? Well, yeah, if corn crashes or something else isn't, but we don't expect that to happen this year. So, again, then I just did some sensitivity here of calf prices versus out prices for the 750s and what profit might be. Again, I was at 280 in and 230 out, so my $50 is right in there. But we go down to those 265 calves that I showed you, you know, that were at the market. We had 265 to 290 calves on that market last week, and so that makes a big change in potential there of profits. So maybe adding some value to some cheaper calves is a way you can background. You know, some people, John mentioned corn, and some people kind of question my 260 corn because it's 180 or something in minute, I guess, or, you know, at Berthold there, just over 2. But at these prices of feeder cattle and at lower corn prices, actually corn prices don't make a big difference. Again, you know, if we take $275 calves, you know, corn prices from $2.20 to $3, you're only increasing the break even by about $2 a hundredweight, you know, right in there about $2.19. So we can have a wide range in corn prices there. It doesn't affect the break even price that much. And so again, corn prices all over the board. So a lot of price risk management strategies. Last year, I'll show you a chart in a minute, I guess they didn't work. Maybe some floor protection might be warranted in case some catastrophic event does happen, or whatever, and, you know, kind of pick your poison here. Which is best is, you know, easy for me to say, and if we're going to continue to have an uptrend like we did last year, the cash market is best. If we're going to have a downtrend, you know, pre-pricing them now, futures or forward contracting some would be the best. If you don't know what they're going to do, or if you want some floor, then doing an option or LRP, you know, gives you some floor protection, but leaves the upside potential open as well. So, again, here's the March feeder cattle futures. They've just been up, up, and up. We backed them off, and again, we're down the limit today, but we don't expect them to crash on down by $20 or so on. But again, as John mentioned, volatility is going to be the name of the game, and so it's not unexpected that we'll see limit movements, and we'll, you know, down and some movement up, but, you know, we're pretty toppy here on the chart again, and so our expectations of much higher futures into prices into March are not expected this year like happened last year. Last year, of course, on the bottom here, futures kept going up all the time, so price protection was not necessary. We go back to 2013 here in October, where we had $150 futures. It depends. In 2013, it all depended on when you priced your calves in and the backgrounded cattle out. If you priced them in October here and you came out in January, you did okay. If you priced them in later, you know, say in December, and then you didn't bring them out till March, you lost money backgrounding. So again, it's kind of a, you know, and price protection would have been warranted, so it's a timing issue, and you know, that's all part of the volatility that we're dealing with. So anyway, Carl, I'm going to quit there. I don't know if you want to take a question or move along, but I'm finished.
Tim, I've been looking through the numbers and going, really, it's been a $450 to $600 per head increase compared to last year?
Yeah, we're $100 higher. Yeah, absolutely. On calves.
We talk about our memory is usually 9 months long. We forget about what happened a year ago.
Yes, well,
And
that's what happened. It's not going to happen again this year.
What? So then I'll beg the question, how about it going down? How quick might it go down? Is it going to happen within 1 year, 2 years? Or one BSE?
No, yeah, if we have a catastrophic event, yes, and then like I said, we need to watch corn next year. We're going to have fewer acres of corn, that is a given. We're going to plant more beans, less corn, less double cropping corn for sure in the corn belt. How many acres are going to go down, we still don't know. Now everybody's watching Brazil for their soybean crop and their corn crop will determine prices in the spring to help plan decisions. But we're going to have less corn, and so we're going to have good weather because we need a lot of corn because we're still using corn and ethanol, although we've backed off prices. So that's the thing to watch this spring is acres and corn prices. But otherwise, fundamentally, we're going to have less feeder cattle next year than we have this year. So supplies are going to remain very tight. Again, with demand is improving on the fed cattle side. So should hold calf prices at good levels again next year and even the next year. But I think the advance is over.
Well, from a cow-calf producing standpoint, that's just excellent news to hear.